Okay, let's unpack this. When you hear estate tax, what immediately pops into your head?
Probably huge fortunes, right?
Yeah.
Castles, yachts.
Exactly. Something only for the ultra rich. Most people figure if I'm not a billionaire, it doesn't concern me.
Hmm.
But the reality, and this is what we're diving into today, it's actually way more nuanced. It can be quite surprising, honestly, for anyone planning their legacy or managing an estate.
Yeah, you might be shocked at what actually counts towards that taxable estate.
Which brings us to the main event, Form 706.
That's it. The United States estate and generation skipping transfer tax return. Quite a mouthful.
Really is.
But it's basically the roadmap for figuring out federal estate taxes and also that generation skipping transfer tax or GST tax. That's for people passing away after December 31st, 2023.
And just quickly on that GST tax.
Right. It's essentially an extra tax. It applies to transfers to people who are like 2 or more generations younger than you. Think grandchildren, for example.
Got it. So our mission today.
To sort of demystify this thing, Form 706 looks intimidating, but we want to break down the key numbers, the strategic choices you can make, and some of those surprising elements that can really impact an estate. We're hoping for some real aha moments for you listening.
Absolutely. The goal is that by the end of this, you'll have a much clearer picture. Quick, thorough understanding, maybe some surprising facts, practical takeaways, whether you're planning ahead yourself or dealing with an estate right now. Okay, so first things first, who actually has to deal with this form? Who files it?
Good question. It falls to the executor, specifically the executor of the estate for a U.S. citizen or resident who has passed away. They're the designated person responsible.
Makes sense. And for 2024, what triggers the need to file? Is there a magic number?
There is a big number, yes. For folks dying in 2024, Form 706 must be filed if the gross estate, that's basically everything they owned at death, plus certain lifetime gifts, what they call adjusted taxable gifts, and a specific exemption. If all that adds up to more than $13,610,000.
$13.61 million. Okay, that's substantial.
It is. And those adjusted taxable gifts, that's basically taxable gifts made during life that used up some of the lifetime exemption. But here's the really critical part for many, many families. Even if the estate is way below that $13.61 million mark, the executor still has to file Form 706 if they want to make what's called the portability election.
Portability, right? That's transferring the unused exclusion amount.
Exactly. Transferring the deceased spousal unused exclusion, or DSUE amount, to the surviving spouse. It's a huge planning tool for the future, but you have to file Form 706 to elect it. Doesn't matter how small the estate is otherwise.
That's a key distinction. Filing might be necessary just for that future benefit, even with smaller estates.
Absolutely critical.
Okay, and you mentioned numbers. Are there other key figures for 2024 we should know about? These things change, right? Inflation.
They do. They're indexed for inflation. So a couple more for 2024. There's a ceiling on something called special use valuation we'll get into, that it's $1,390,000.
Yeah, okay.
Then there's an amount used for figuring out the 2% interest portion when you pay estate tax in installments, again, something we'll touch on. That's $1,850,000.
Right.
And finally, the basic credit amount against the estate tax itself is $5,389,800 for 2024.
Wow. Okay. Lots of numbers.
And the big takeaway, like you said, is these aren't static. They change each year. So you always need to check the latest figures. IRS.gov Form 706 is the place to look. It's a dynamic landscape.
Definitely sounds like it. All right. We know who files and the big threshold. Now let's talk about what actually goes into that calculation. The gross estate.
Yeah, this is where people often get tripped up.
Because it's not just the obvious stuff, like your house, your bank account.
Exactly. The estate tax isn't just on what beneficiaries inherit directly. It's levied on the entire taxable estate, and that net is cast very, very wide.
So what kinds of things get pulled in that might surprise people?
Well, beyond the basics, real estate, cash, stocks, you've got things like annuities. The includable portion of joint accounts, like joint bank accounts, or property held as joint tenants with right of survivorship. That's usually straightforward.
Okay, standard stuff. What about the less obvious?
Life insurance. This is a big one.
Ah, yes. Everyone thinks they name a beneficiary. It's outside the estate, right?
That's the common myth.
Right.
But if the person who died, the decedent, kept any incidence of ownership.
Meaning, like control over it.
Exactly. The right to change the beneficiary, the right to surrender the policy for cash, pledge it for a loan, borrow against it, even just holding on to a possibility of getting it back if the beneficiary died first, what's called a reversionary interest over 5%.
Wow.
If any of that control existed, boom. The entire death benefit gets pulled back into the gross estate for tax purposes, even if it's paid directly to, say, the kids.
That's huge.
Yeah.
I can see how that would be a massive aha moment, probably not a pleasant one during estate administration.
Oh, absolutely. And then in our modern world, digital assets.
All right. Crypto, NFTs.
The IRS instructions are clear now. They define them. Digital representations of value recorded on a cryptographically secured distributed ledger. So cryptocurrencies, stablecoins, NFTs, they're all in.
No hiding the Bitcoin wallet.
Nope. Also, property where the decedent had a general power of appointment, meaning they could direct who gets it, including themselves or their estate, and their share of community property in states that have it.
So the takeaway message here is your estate could be a lot bigger and, frankly, more complex than you might think on the surface. That life insurance policy you set up years ago, your crypto holdings, it all potentially counts.
It really broadens the scope. Okay, so once you know what's in the gross estate, the next step is understanding the tools the executor has. There are some really important strategic elections.
Elections, meaning choices they can make?
Exactly. Choices that can potentially lower the value of the estate for tax purposes or reduce the tax bill. These aren't just check-the-box items. They require real consideration.
Okay, like what? Let's start with one.
A big one is alternate valuation. Section 2032.
Alternate valuation. Sounds like valuing things differently.
It is. Instead of valuing all the estate assets on the date the person died, the executor can elect to value them 6 months later.
Oh, interesting. So if the market drops right after someone passes away.
That's the classic scenario where it's useful. Imagine stocks plummeting. This could significantly lower the reported value of the estate.
Seems like a no-brainer then, if values go down.
But there's a catch. Always a catch, right?
Usually is with taxes.
You can only make this election if it decreases both the total value of the gross estate and the total amount of estate and GST taxes due. Both conditions have to be met.
Okay, so it has to reduce the value and the tax, not just one.
Correct. And once you make the election, it's irrevocable. You can't change your mind later.
And what about assets sold during those 6 months?
Good point. If property is sold or distributed within that 6-month window, it's valued on the date it was sold or distributed, not the 6-month mark. Anything still held at 6 months is valued then.
Any weird exceptions?
There's a little wrinkle for assets whose value changes just due to the passage of time. Think like patents running out or leases getting shorter. Those are still valued as of the date of death, though you adjust for other market changes.
So, alternate valuation. Potentially powerful if asset values drop, but you need to meet both tests, lower value A and D, lower tax.
Got it.
What's next?
Special use valuation. Section 2032A.
Okay, special use. Like for specific types of property.
Exactly. This is for certain farms or real property used in a closely held business. It lets the executor value that property based on its actual use, its farming value or business value, instead of its highest and best use fair market value.
Which can be much lower, right?
Yeah.
If farmland is near a developing area, its development value might be huge, but its farming value is less.
Precisely. This can be a massive tax saver for farming families or family businesses trying to keep the operation going without having to sell land to pay taxes based on potential development value.
Are there qualifications? I assume it's not for just any property?
Oh, definitely strict qualifications. The decedent had to be a U.S. citizen or resident. The property has to be in the U.S. It must have been actively used as a farm or in the business for 5 out of the 8 years before death. And this is key. It has to pass to a qualified heir.
Qualified heir, meaning family.
Yes, specific family members, ancestors, spouse, lineal descendants, spouses of lineal descendants. It's tightly defined. And it requires material participation.
Material participation. Sounds like you can't just be a passive landlord.
You got it. The IRS instructions are very clear. Passively collecting rents or merely advancing capital and reviewing a crop plan is not sufficient. You or a family member need to be actively involved in the operation.
Makes sense. Keep it for genuine family farms businesses. Is there a limit on how much value reduction you can get?
Yes, there's a cap.
Yeah.
For 2024, you can't reduce the fair market value by more than $1,390,000 using this method. Still, a very significant potential reduction.
Okay. So, alternate valuation, special use valuation. Any other big elections?
One more key one. Installment payments under Section 6166.
Paying the estate tax over time.
That's the idea. If a large part of the estate's value is tied up in a closely held business, coming up with the cash to pay the estate tax within 9 months can be really tough. might force a sale of the business.
Right, so this offers some breathing room.
Exactly. It allows the portion of the estate tax attributable to that closely held business interest to be paid in installments over a period of years. In fact, you can defer the principal payments entirely for up to 5 years, paying only interest, and then pay the tax over the next 10 years.
That sounds incredibly helpful for liquidity. What qualifies?
The value of the closely held business interest must be more than 35% of the adjusted gross estate.
Adjusted gross estate,
Yeah.
meaning gross estate minus certain deduction.
Generally, yes. Things like debts, funeral expenses, administrative costs. And the definition of closely held business is specific, too. It looks at things like percentage ownership or number of partner shareholders. A key point here is that passive assets held by the business assets, not actually used in conducting the trade or business, don't count towards meeting that 35% threshold or toward the amount of tax that can be deferred.
So only the value tied to the active business operation qualifies.
Pretty much. And one more complexity. There's an option to treat certain holding company stock as business stock to qualify, but if you do that, you lose the 5-year deferral and the special low 2% interest rate on part of the deferred tax. So trade-offs.
Lots to weigh for the executor there. Okay, those are some powerful strategic tools. Now, let's talk about something mentioned earlier that sounds like a game changer for married couples. Portability.
It really is. Section 2010 C4. Introduced for deaths after 2010, it allows the estate of the first spouse to die to transfer their unused estate tax exclusion amount, the DSUE amount, to the surviving spouse.
So if the first spouse's estate doesn't use up their full, say, $13.61 million exemption for 2024,
The leftover amount can be passed to the surviving spouse. They can then add that inherited DSUE amount to their own exemption when they pass away, or even use it for lifetime gifts.
wow. So a couple could potentially shield double the basic exemption amount from estate tax.
That's the potential, yes. Millions more sheltered. It's huge for planning.
So whose unused exclusion do you get? What if someone remarries?
Good question. You get the DSUE amount from your last deceased spouse. If you remarry and your new spouse dies, their DSUE amount would then replace any DSUE you might have had from a prior deceased spouse. You only get to use one DSUE amount at a time, the most recent one.
Okay, the last deceased spouse rule. Makes sense. And how do you actually get this portability? Does it just happen?
No, this is crucial. It doesn't happen automatically. The executor of the first spouse's estate must make the election by filing a complete and timely Form 706.
Even if the estate is small, even if it's below that $13.61 million filing threshold we talked about.
Yes. Even if no tax is due and the estate is well below the threshold, you must file Form 706 solely to elect portability if you want the surviving spouse to have that DSUE amount available later.
That seems like something easily missed.
It was, and many people did miss it, especially in the early years, which leads to a really important update.
Good news.
Potentially very good news for some. The IRS recognized this was an issue. So under a procedure called Revenue Procedure 2022-32, estates that weren't otherwise required to file Form 706 but missed the deadline to elect portability now have an extended window.
How long?
They can file Form 706 to elect portability up to the 5th anniversary of the decedent's date of death.
5 years. Wow, that's a significant extension. A real second chance.
It is a crucial relief provision, but once you do make that election on a filed return, it's generally irrevocable. You can only revoke it if you file an amended return before the original due date, including extensions, would have passed.
So file it right the first time. Or use that 5-year window if you missed it and weren't otherwise required to file. Got it. Portability, very powerful. Hashtag navigating deductions and credits.
Okay, beyond valuing assets and using portability, estates can also take deductions and credits to lower the tax bill, right?
Absolutely. Several important ones are detailed on different schedules of Form 706.
Start with the big one, the marital deduction, Schedule M.
Right. This allows for an unlimited deduction for the value of property that passes from the decedent to a surviving spouse, provided the surviving spouse is a U.S. citizen.
Unlimited, so anything left to a U.S. citizen spouse is typically not taxed at the first death.
Generally, that's the outcome. It defers the tax until the second spouse's death. The complexity often comes in with how the property passes. Certain interests, called non-deductible terminable interests, like if the spouse only gets income for life and then it goes to the kids, generally don't qualify on their own.
So if it's not an outright inheritance,
Exactly. But there's a fix for many common trust structures. An executor can make a QTIP election qualified terminable interest property. This allows certain trusts that pay all income to the spouse for life to qualify for the marital deduction.
QTIP. Okay. And what if the surviving spouse isn't a U.S. citizen?
Then the unlimited marital deduction generally doesn't apply directly. To get a similar benefit, the property usually needs to pass into a special type of trust called a QEOT, a qualified domestic trust. More complex rules there.
Got it. So, marital deduction for spouses. What about giving to charity?
That's the charitable deduction on Schedule O. You can deduct the value of bequests or gifts made to qualified charitable organizations, religious, educational, scientific, etc. The instructions also specifically mention deductions for qualified conservation easements.
So, leaving money to charity reduces the taxable estate. Makes sense.
Definitely. And then there are credits. Credits reduce the tax dollar for dollar, unlike deductions, which just reduce the taxable amount.
Even better. What kind of credits?
One is the credit for foreign death taxes on Schedule P. If the decedent was a U.S. citizen or resident and paid death taxes to a foreign country on assets located there, this credit can help avoid double taxation. It might be available under U.S. law or a specific tax treaty.
Useful for estates with international assets.
Yes. Another important one, though less common, is the credit for tax on prior transfers, Schedule Q.
Prior transfers. Sounds like if you inherit something and then die soon after.
That's exactly the situation it addresses. If the current decedent, the transferee, received property from someone else, the transferor, who died within 10 years before them, or even within 2 years after them.
Wait, 2 years after. How does that work?
It's less common, but could happen if, say, the transferor left property in a trust that wasn't fully distributed or finalized before the transferee died shortly thereafter. The point is to provide relief when estate tax might hit the same property twice in relatively quick succession.
Okay. Is the credit always the same amount?
No, it diminishes over time. It's 100% credit if the transferor died within 2 years, before or after the transferee. Then it drops by 20% every 2 years, 80% for years 3, 4, 60% for years 5, 6, 40% for years 7 to 8, 20% for years 9, 10. After 10 years between deaths, the credit is gone.
Interesting phase out. Okay, one more schedule you mentioned. PC.
Schedule PC, protective claim for refund. This isn't a deduction or credit itself, but it's a way to preserve the estate's right to claim one later.
For what?
For deductible expenses under Section 2053, things like executor fees, legal fees, certain debts or claims against the estate that haven't actually been paid yet, or the amount isn't certain when Form 706 is due.
So if there's ongoing litigation, for example,
Yeah.
the legal fees aren't finalized.
Exactly. By filing Schedule PC, the executor puts the IRS on notice that there might be a future refund claim once those expenses are finalized and paid. It keeps the door open past the normal statute of limitations for refunds. It's a smart administrative move.
Yeah, sounds like a crucial safety net for uncertain future deductions.
Yeah.
#TAG administrative essentials and avoiding pitfalls.
So we've covered the assets, the elections, deductions, credits, but getting the administrative side right is just as vital. Mistakes here can be costly.
Right. Let's talk deadlines first. When is this thing actually due?
The deadline is 9 months after the date of death. That's for both filing the return and paying any tax owed.
9 months. Okay. Is there any wiggle room on the filing?
Yes, you can get an automatic 6-month extension for filing the return by filing Form 4768 before the original 9-month deadline. But crucially, that extension is only for filing, not for paying.
So payment is still due at 9 months, even if you get an extension to file the form itself.
Correct. You generally need to estimate the tax due and pay it by the 9-month mark to avoid penalties and interest, even if you file the return later using the extension.
Good distinction. How do you actually pay?
Several ways. The IRS prefers electronic payments, like through the Electronic Federal Tax Payment System, EFTPS. You can also do a same-day wire transfer, or you can still mail a check or money order.
Can you just write one big check if the estate owes a lot?
Funny you ask. There's actually a specific instruction about this. The IRS cannot accept a single check for $100 million or more.
Seriously?
Yeah.
$100 million limit per check.
Seriously, if you owe that much or more, you have to split it into 2 or more checks, each under the $100 million threshold. A niche problem, perhaps, but it's in the instructions.
Wow. Okay. Who needs to sign the return if there are multiple executors?
Only one co-executor needs to actually sign the return. However, and this is important, all co-executors listed on the return are legally responsible for the information filed and are liable for any penalties if something's wrong.
So signing is one thing, responsibility is shared.
Exactly. And if you use a paid preparer, they have their own signature requirements and must give you a copy of the return.
What if you file and then realize you made a mistake or new information comes up?
You'll need to file an amended return. You basically use another Form 706, write supplemental information clearly across the top of the first page, attach a statement explaining the changes, and include copies of pages 1 through 4 of the original return you filed.
Okay, a specific process for amendments. And what about supporting documents? What needs to go in with the return?
Several key things. Always include a copy of the death certificate. If the decedent had a will, died testate, include a certified copy of the will.
Certified copy, not just a photocopy.
Correct. You'll also need appraisals for real estate, art, or other hard-to-value assets, copies of any gift tax returns, Form 709, the decedent ever filed, mark those clearly as exhibits, and Form 712, which is the life insurance statement you get from the insurance company for every policy included in the gross estate.
Seems like gathering all that documentation is a big part of the job.
It really is, and getting it wrong can lead to penalties. There are penalties for filing late, paying late.
And forgetting the values wrong. Right, you mentioned that earlier.
Yes, the valuation understatement penalties can be harsh. A 20% penalty if the value you report is 65% or less of the correct value, and that jumps to a 40% penalty for a gross valuation understatement if you report a value that's 40% or less of the correct amount. That can really sting.
Ouch. Definitely want to get those appraisals right. Anything else on the admin side? Closing letters.
Good point. The IRS used to automatically send an estate tax closing letter, ETCL, once they accepted the return. They don't do that anymore.
So how do you know the IRS is done with it?
If you want that formal closing letter, you now have to request it specifically. You do it through pay.gov, and there's a user fee. It was $67 as of late 2021, and you generally have to wait at least 9 months after filing to make the request.
Pay a fee for the closing letter. Okay, is there another way?
Yes, a free alternative is to request an account transcript online or by mail.
Right.
It won't be the formal closing letter, but it can show the status of the account, whether the return was processed, and if the tax was assessed and paid.
Good to know there's a free option.
And one last related item, consistent basis reporting. There's another form, Form 8971, that the executor generally has to file and provide to beneficiaries who inherit property from the estate.
What's that for?
It ensures that the beneficiary uses the same value reported on the estate tax return as their cost basis when they eventually sell the inherited asset. It prevents beneficiaries from claiming a different, maybe higher basis to reduce their own capital gains tax later. Consistency is key.
Ties everything together. And one tiny detail rounding.
Yes. You can round cents to the nearest whole dollar on the return and schedules. Drop amounts under 50 cents, increase amounts from 50 to 99 cents to the next dollar. But the key is consistency. If you round one amount, you have to round all amounts.
Yeah, all or nothing on the rounding. Hashtag tag outro.
Wow.
Okay, this deep dive into Form 706. It really underscores that estate planning and administration go way beyond just having a will.
Absolutely.
It's this intricate dance with tax rules, inflation adjustments changing year to year, valuation strategies, even digital assets now. Knowing these details, understanding the instructions and the elections, it really empowers you. Whether you're planning for your own future, making sure things are set up right, or if you're the executor tasked with navigating this for a loved one.
It provides clarity and can potentially save significant amounts of money and headache down the road.
Definitely. And thinking about the bigger picture.
Yeah, if you connect this to broader trends, think about how family structures are changing. Remarriage is common, blended families. That impacts things like the marital deduction, QTIPs, QDOTs, even portability with the last deceased spouse's rule.
Sure.
And the types of assets people own are evolving so rapidly. We talked about digital assets, but what's next? Will other forms of digital value, or maybe even things like carbon credits or unique intellectual property, become major components of estates that challenge these traditional rules?
That's a fascinating question. It leads to a final thought for everyone listening.
Beyond the assets we typically think about today, houses, stocks, even current digital assets, what emerging forms of wealth, or maybe even shifts in how we define family or legacy, might unexpectedly reshape your estate planning needs over the next, say, 10 years. Something to really mull over.
A provocative thought indeed. What does the future hold for what constitutes an estate?